Okay, I suppose just to just go through, I suppose, really the objectives of our training session today. So there's a couple of areas we're going to kind of hone in on really, and what is the financial management policy, the roles and responsibilities of the different people and entities and whatever in the organization, you know, how to maintain strong financial management, effective planning and budgeting, and then good practice around your record keeping, your bookkeeping and your accountancy, and then the financial controls and that surround that, I suppose, and the reporting that comes from it. And then I suppose, you know, generally that you're all in, I suppose, service orientated organizations. Staffing costs is generally 70 to 75% on average of the costs of organizations of that kind. So that, you know, that's an area obviously we'll have to look at as well. So moving on to the next slide, that's just some information about the slides there. So into the, you know, what's the function of your financial policy? And I suppose really, like, it really is a working document, so to speak, in the sense that it you know, people often say, I've started a job, I don't know what to do really. And I suppose this is where the policy comes in, you know, really. It defines the duties, you know, safeguards the assets, you know, stops fraud happening, and then it monitors as well, really. And then really, I suppose, the bread and butter really is the maintaining the adequate records, the stuff that everyone, I suppose, is familiar with doing, really, you know, putting in your checks and your invoices and whatever it is that you record in your account system to ultimately, you know, keep proper books and records, which I suppose really is the ultimate remit of the board, who in turn then put management in place to do it, and then staff are hired to actually do the nitty-gritty of that work. So that's really, I suppose, on the next one then, what is a financial management policy? You know, so it's everything from the top of the organization, from board level, all the way down to the person that puts in the checks and does the banking online and all that stuff, and everything that happens in between, from the board through management down to staff. So it contains all the guideline, you know, so your board really takes the strategic decisions. They kind of, you know, they're the ultimate captain of the ship, I suppose, really, that sets the direction the organization is going to go in. And then, so they need to adopt the financial management policy for the organization. They need to set the tone and set the culture for the organization of how it's going to operate. It's also very important for funding agencies. I suppose if any of you work in agencies where you're getting funding from state agencies, you know, they all want to see as financial management policy. How do you manage your finances ultimately? And then the financial intent for financial management. You know, what do you want to achieve from this? Define limits, you know, put limits on what staff can and can't do, you know, and then manage risks. I suppose you've all, you know, some of the other presenters, I think, really would talk about risk as part, you know, it's tied in with governance, but it's also tied in with finances. And, you know, your finances, obviously, there's always risks with it. You know, you can't avoid risk. You can just, you know, try and control the risk as best you can. And it should comply with established best practice. You know, some of you come across SORP and other best practice in the charity sector. And all organizations need it. Doesn't matter what size they are, you know, whether they're 50 million or 150,000, they all need to have a financial management policy to manage what comes in and how they spend it. And it should be reviewed, you know, at least every 3 years. But what will probably happen, in fact, is, you know, given that there's always, you know, I suppose, internal audits by funders in the sector, and, you know, there's always something happens and it becomes a topical document, you will often find you're adding on to your financial management policy, you know, and some people bring those reviews more often, even annually, you know, where you'd put it maybe on your agenda item. But again, that's up to the board really. But in a lot of organizations, you know, there may not be need to review it that often, and sometimes it's in response to an event more so than something a planned review. So I suppose just really to differentiate between what's a policy and what's a procedure, you know, and I suppose the policy is the overriding, you know. You might have a policy on fixed assets to have a register, for example, and to protect your fixed assets, you know, and the procedure then is how you do it, you know, recording those assets, you know, physically counting them, recording what's there, how much they're worth and all that. So that's kind of the difference between a policy and procedure. So policy is a set of rules or guidelines to achieve a specific goal, and the goal is compliance really. And the policy then is how that the procedure then is how do you achieve that policy, and the step-by-step instructions. So you'll find often the procedures, the policy can be kind of generic, but specific to the point, this is what we want to achieve. And the procedures then obviously go into an awful lot more detail on how you achieve that policy. Now, you will find in practice really that the policies and procedures are often in the same document. You'll start with the policy and go on to your procedures then with how you're going to achieve this really. So financial management in its very generic sort of, I suppose, definition really is, look, take it all, when you get all your checks and your lodgements and all the information recorded, it's about, planning for that, comparing it against budget, and how do you get the reports out of it to inform management to run the organization, and I think everyone has a basic understanding of that really. I suppose it's when you get into the more specific policies that maybe it's different. I suppose we've alluded to it already, but the different roles and responsibilities in the organization, and I suppose we're just taking a top-down approach here really. Your board of directors, you look at the life cycle of an organization really, would be started by the subscribers or the people that set it up. A board of directors is appointed. They go and employ a management team then to run the day-to-day operations of the organization, and they then in turn hire staff to do the jobs really. So I suppose no big secrets there. So the board of directors really, they're responsible for the long-term stability, and it's very important they understand their role, because you often do hear from organizations that board of directors, they're over involved or they're under involved, so really it's very, and I suppose that would have been covered, I suppose, in the governance sector as well, all your director's handbook and your board, and when they're brought in, that it's clearly explained to them what their role is and all that, so that's the board of directors. The management team then, I suppose the management team is, they're kind of in the middle really, and they have to manage up and down. So they have to manage the relationship between themselves and the board, because in most cases in these kind of organizations, the board is voluntary, so you can't expect the board to be doing a lot of work. They provide oversight and they provide direction, and then they provide ultimate control, I suppose, really. But everything on the day-to-day, they put the systems in place for the manager to do the job of operating on a day-to-day basis. So there is some crossover in that he will be doing some monitoring of the staff that report back to management. And the management team will also be involved in compliance and reporting back to the board as well. So I suppose the relationships are pretty fluid. The staff then, obviously, they do all the inputting. They, I suppose, largely prepare the reports, and they follow the procedures that are put in place for them to achieve the financial policies and management. So, any questions so far? Sorry, I don't want to just go on and on here. And feel free to ask a question or put in at any stage. There's no problem. I suppose until we get to the policy documents themselves, a lot of what we're doing here is kind of, I suppose, the theory behind it really, and we'll get into the actual practicality of the policies then later in the session. So I suppose basic financial skills, essential to make sure you have proper accounting records and that you have proper financial information. And this is covered in the Companies Act, and the directors are obliged by law to make sure that there's proper records maintained by the company. And they have to make sure that management has the necessary skills and that you have the suitably qualified staff to make sure all this happens. So you're talking about the basic bookkeeping, budgeting so that you can compare against budget, managing your finances, your cash flows, and making sure you have enough to pay your expenses as they fall due, and then producing reports and analyzing the information coming from those reports, and extracting the information as to why variances are happening, and doing a forecast, I suppose, if you want, to the end of the year, and then communicating that to all the various stakeholders, whether that's the board or whether it's funders, external stakeholders, or whatever. But you need to make sure you have the resources and skills in place to do that. So your financial system then, is everything from giving regular financial reports, accounting for funds. Many of you may be getting funds from different state sources. So not alone do you need to keep an overall record of income and expenditure, but you might also need to break that down by funder, so that if you get a certain piece of funding with conditionality around what you spend that money on, the likelihood is you need to report back to that funder, on an interim basis, at various intervals, or you need at the end of the scheme to show what that money was spent on and get final sign off on it. So the other thing, I suppose, is not, so that's what we talk about earlier, that the money is spent for the purpose that it was intended. And I suppose not over-promising as well, that you can meet your financial obligations and that you do have the resources in place to meet those. And then taking precautions, that the funds are spent for the purposes they're made, and putting the proper controls in place and planning. Moving on to the next section. So effective planning and budgeting, so I suppose really budgeting is really important for any organization, cutting your cloth to measure, really making sure that you stay within your means, and that whatever funds you have or are going to receive will be enough to deliver the service you're getting them for, and to make sure that you report against them then, and that you can make sure that there are no variances or no overspends. So managing the budgets, consider income generation. So I suppose really, if you're not going to get enough funding from state agencies or from your normal, have you a means of generating some extra income yourself, and whether that's to feed into your reserves policy, where the organization, from a good governance point of view, it needs to kind of try and build up reserves, for a rainy day fund, or for a redundancy situation, or for delays in funding, and we'll go through that reserves policy in more detail later. Risk management, risk registers, you've probably all heard those buzzwords around, really, but again, you need to manage the risk around the finance, and business continuity, have you enough reserves to keep going? If there is a delay in funds at the start of the year, are you carrying over enough to keep going? And performance, again, we mentioned SORP earlier on, but I suppose there is a move, well, there has been for a while really, but a move to, try and report not just on the financials, but on the performance, on the services you delivered using those finances, so not just about just reporting on finances in its own, but showing what you used that money for and what did you actually produce, and, the statistics and stuff around it. And then consider strategies, so if I suppose when we're talking about strategies to manage cessation, we're talking about really, if you lose one funding stream, does it impact the overall organization, and have you plans in place to replace that funding or whatever? So I suppose it's just to be mindful of all these things. So effective planning and budgeting, I suppose, just to summarize, and we'll go through each of these in a second, but really your strategic plan for your organization really is, it could be a 3-year, it could be 5-year, it could be any, but generally it's medium to long, and you're looking at where does the organization want to be or get to in 3-5 years time, and that's the overall, I suppose, the plan for the organization, and that would happen at board level, with management support. The annual business plan then is the more short term, that's how are we going to plan for the next 12 months effectively. So that's where and that feeds into your budgeting and your cash flow forecasts. Your budgeting could be, for the current year, but you could do a 3-year budget, or you could do, any limited budget to tie in with your strategic plan. Your cash flow forecasting then again is more short term generally, but it look at, have we enough money in the bank really to get through the next couple of months or even longer, and so on. And then evaluating the organization, how have we done, and so on, how are we doing so far. Stability and income generation. Again, like I suppose if you're getting enough funding, through your normal, I suppose, mainstream funding streams and whatever, maybe that's not hugely important, but generally if you need to, I suppose in the current climate where a lot of the state funding coming in is just to cover the service that you're expected to provide, there's usually very little surplus to feed into reserves, and then generally now you have to get permission to do that. So I suppose if you can have some unrestricted funding, whether it's hiring out a room or it's doing courses or whatever it is that the organization can, or even bucket collection outside, the supermarket or whatever. That there are other ways to bring money into the reserves, and we'll talk about them later. Then risk management, identifying the risks that you have. I suppose in small organizations, one of the risks is that you don't have enough people where you can spread the tasks around. So in small organizations, you will find, a small number of people are doing all the different transactions. So you have to look and see that's a risk, for example, that you can't segregate those tasks. And again, we talked about exit strategy, all right, if you lose funding and so on. So strategic plan, I suppose it's there for all to read really, but it's a process of the organization defines its direction. It's the very top line, the very basic, the main object, I suppose, of why the organization exists. Where does it want to be in 3 years' time, and so on, and what do you want to do in that thing? The budgeting then is a planning tool around the finances, and that you can, I suppose, set your budget and then you compare the reality against that budget. And sometimes people look and say, well, that budget isn't reasonable anymore, and they go back and they update their budget. That's not unreasonable either. But generally with organizations, you will kind of stick to your budget for the year. And then if there is deviation from that for good reason, you will probably do forecasts to the end of the year to see how do we expect to by the end, how do we expect to come out of this against budget? Cash flow management is pretty self-explanatory. So evaluating performance, I suppose, in whatever your organization is, you will have key performance indicators. You may not use that language for describing them, but there are certain things you can measure how your organization is going. I suppose if you're in the homeless services, you'll see how many people did we actually find homes for. If you're in drug addiction, how many people did we help? How many one-to-ones did we do? So there's all these statistics, and they're not necessarily financial. Now, you can look at key financial ones as well. Obviously, people would look, how much cash in the bank have you compared to how much money is owed out, and these different financial ratios. So that is important, that, that you can measure your outcomes really, and show, was the money spent as it should, or spent well, I suppose, really in achieving those tasks. Financial sustainability, we talked about income generation already. I don't have anything more to say on that. Reserve planning. I suppose there has been some feedback really, and I think the reserves policy people are always, and there is one in the financial policy document. And reserves, I suppose, really everyone is concerned, do we have enough reserves put aside? I suppose really there was the 13, historically had this kind of, it was recommended that an organization would have 13 weeks expenditure in reserves, and that was kind of your golden target really. But 13 weeks is 3 months. It's 1/4 of your annual expenditure in reserve. Now that might be fine for, the older organizations that are around a long time and that had time to build up those reserves, and they do have unrestricted income streams to allow them to build it up. But your reserve policy can be around where you want your target reserves to be, how you're going to get there, and then how are you going to spend them? What do you want those reserves for? So it may be something like to cover delays in funding, or it may be to cover if funding stream ends and you get no support from the state agency or whatever to cover redundancy, for example, that you have the money there to pay that. So it's the responsibility of the directors, really, the board of directors, to set the tone on the reserve planning and the reserve policy and what they think the organization needs. So risk management, again, I think we've talked a good bit about that already. But your risk, looking at what risks has the organization, what could possibly militate against the organization, being able to carry out its financial management policy, or in any way hampers that. And then how do you mitigate against those risks? How do you plan for them and reduce the impact of them? And we talked about exit strategy and small funding streams already. Good practice, and for bookkeeping, I suppose we look since COVID. I suppose you're all aware we're all online today, obviously, and the same is happening really with, I suppose, computerized accounting systems. That there's a move away from your desktop or your manual or your Excel really to cloud accounting systems really, where you log into them exactly like you log into your Gmail, you know, and all your information, your accounts information is there. And whether you log in from at home or in the organization, or whether the treasurer can log in, you know, it gives great access to the information. But what it also does really is it connects up with your banking, with your banking online, and it pulls in the information into the system, so that you're moving away from spending time inputting checks and payments and all, and so they all come in from the bank feed into the computer, and then you know you can have your budget in there and you input. There's very little inputting. You're doing more analysis and putting it against the various income streams and whatever. And obviously computerized payroll packages, you know, the PAY modernization, as you're probably all aware, came in 2019. So everyone literally is on computerized payroll packages now. So again, given that your staff costs are such a large part of service-driven organizations, it's absolutely crucial that you have controls and good systems around your payroll. Just a few things, I suppose, really, because I suppose if you're dealing with state agencies and you have to report on a money in, money out basis, like Pobble, a lot of the Pobble ones and the creches and so on, it's done on a sort of whatever was lodged to the bank in the period and whatever was paid out of the bank in the period. We'll also look at apportionment of costs in a minute, and then obviously the production of management accounts. But your cash accounting versus your accrual accounting, I suppose your cash accounting is your basic. It's a bit like you do in your own household, really, where you look at how much money came in and how much money did we spend, you know. So you're only talking about what came into the bank, what left the bank. That's really your cash accounting, so to speak. Your accrual accounting is where you look at the bills that came in during the period and not just the ones you paid. You're kind of looking at them all. And also, if you issued invoices out, you know, if you're in a resource centre and you're issuing invoices for rental income, for hall hire, or for whatever it is, you will record your income based on the invoices that you issued rather than the ones that you got paid for. And the same with your purchase invoices, you know, so whatever you spent or you and you got bills in for, that's your expenditure and not just the ones you paid for. So that's kind of a difference there, but most accounting systems will cater for either. Your apportionment of costs then really is, and I suppose that part of financial management really is where you're getting state funding from a number of sources. And you say, for example, you have an office administrator, well, 20%, for example, of her salary might be covered from a certain funding stream, another 30 from another. So apportionment of costs, and probably any of you that have had internal audits from the HSE or for whoever, you know, a lot of them look for an apportionment policy now. So really you need to document, how do we apportion our costs, you know. So like the case of that administrator or your telephone bill, where does the money come from to pay those? And it may come from multiple sources. And I suppose the third one then is management accounts. And I suppose that's a dead cert really, that every organization should be producing management accounts. And these should be presented to the board of directors every time they meet, or if there is a financial committee of the board, then it would be presented to them, and they in turn then would report to the board when they meet. But your management accounts is, so again, we see it so often, you know, and from third party internal audits and so on, that there needs to be sign off by the board. They need to show an awareness that they got this information and it was considered properly at board meetings and whatever, and they took on board the results of it and so on. So management accounts are so important for organizations. Taxation, just a small thing on it really. Corporation tax, or, you know, if you're dealing with a non-incorporated non-for-profit organization, it would be income tax. But generally charities are exempt from, you know, most non-profit making organizations are exempt from tax anyway, and charities are certainly exempt from income or corporation type tax. PAYE, there's no exemption from that. All organizations that employ staff have to return PAYE returns and make their payments. VAT, just to mention that most organizations are exempt from VAT, but if you run a charity shop, or you have a canteen and you're over the threshold, you may need to VAT register for those, or a coffee shop or whatever. And also, if you get state funding for capital projects, you need to VAT register. And and they may be only once off, so it might be only temporary registration, and you have to apply relevant contracts tax to whatever builder or whoever you get in that wins the tender or whatever for it. So that's just a small bit on taxation. Again, any questions, or does anybody want me to slow down or anything? Just let me know, please. Banking, I suppose, look, no financial policies worked or procedures is worth its salt really if there isn't a piece on the banking, on who has the responsibility for the banking, how many signatories are required, you know. So it's really important that you keep a copy of the bank mandate so that, you know, the board and management, everybody knows who is responsible for signing off on payments. And your financial policy procedures then you can have the detail in the procedures really as to the levels of payment that a manager can approve without having to get sanctioned from the board. And the same with whether if you had a finance officer reporting to management and so on, the same with them. You know, so at the very least, there should be 2 authorizations. You know, there should be 2 people should have to sign off on payments. No one person should have total control on who they pay, and they certainly shouldn't be in a position to pay themselves. You know, so they're just basic stuff. But we look at that when we look at the policy later on. Record keeping, we talked about that earlier. You know, and again, it's self-explanatory. You know, but every transaction, financial or otherwise, really in the organization needs to be recorded. You know, and you know, if you don't record it, you can't measure it. You know, you need to keep that information. All transactions, right down to petty cash or credit cards or whatever it is, that all needs to be recorded, reconciled, and reported on in order to measure it and control it. Cash handling, you know, I suppose, you know, you've all probably heard of, you know, any of the charities that came to the media attention or to the charity regulator attention. Often credit cards, petty cash, all that stuff, you know, the media love all that kind of thing, really. And it's, in a sense, you know, again, we see it in internal audit, where sometimes even the sums may not be that big in petty cash and so on. It is an area that an organization is very exposed, you know, because it is hard to manage, you know. So you need to look at the physical controls around the cash to make sure people don't have access to it if they shouldn't have access to it, you know. Physical controls over the handling of income, you know, and having ways, I suppose, to verify your income. You know, for example, like if you're hiring out a hall, you'll be looking at how many people rented that hall in the last week or last month, and you will compare that against the amount of income we should have received in against the amount of money we actually received in, you know. And so there's ways of checking that as well. And then again, we mentioned the physical controls, having a cash register. The petty cash system, using the impress system, which, you know, some of you might be familiar with, really. But I suppose you would, you know, when you start out with petty cash, you might decide we need to have a float in petty cash of €100 or €200 or whatever. So instead of topping it up by around some figure every month, then when it goes low, you top it up to the degree to bring it back up to whatever float you decided at the start. So if that figure is 200 and there's only €32 in the petty cash day, you will write a check or you'll withdraw cash for €168, for example, to bring it back up to €200. So in that case, and you will only reimburse on the basis that there is receipts there to match what you were reimbursing or bringing, replenishing the petty cash. So straight away, it forces you to actually make sure that there's receipts there backing up all the expenditure that was made. Minimizing cash handling. I suppose, look, you're all aware really since COVID that there's been a huge move away from cash, you know, from the point of view that the securities issues with it, there's recording issues, I suppose there's health and safety issues with it as well. And people are just getting more used to the card machine. So, you know, most centres and whatever organisations now, and creches and where they are taking in money from parents in the case of creche and whatever, they will have a card system in place, a merchant visa or whatever it's called. And the other one, I suppose, really that, you know, if you want to move, if you find that your petty cash system, I suppose, you're using more cash than you would like, there are cash card systems out there, like Saldo is one that I've come across. It was probably one of the first ones with charities. You know, it's like Revolut, which maybe a lot of you are familiar with, really, where you issue a card to staff, whoever needs to use cash. Now, they can still go to their ATM machine to get out cash if they need to, but the whole idea of the card is they can go down to their Tesco or their Duns or whatever and buy the milk for the office or buy stuff for program costs or whatever it is they're doing. And there's an app on their phone and they take a picture of the receipt and they upload it. And you know, if you have your cloud accounting system, then that'll come, all that information will feed across into your account system, you know, so it automates a lot of that process, but it also, you have control from your office on how that money is. You can see exactly where the money is being spent. And from, I suppose, from the finance administration side, you can control what money is put onto people's cards. And if they lose their card, you can take the money back off it again, you know. So I suppose the whole cash handling is a huge part in some organizations. Like more organizations have very little cash at all, and they probably feel the risk mightn't be high. But, you know, you look at creches and you look at, I suppose, centres where they have pay for play for basketball or indoor soccer or whatever it is, where there's a lot of groups paying with cash. You need to have the systems in place to both record it and control it, I suppose, and just safeguard it. So the other reason, I suppose, for financial controls is the prevention of risk. You know, you need to recognise where are the risks in your organisation. You know, if you're, you know, if you're a community organisation and the hall is open at night and there's very few staff on hand, you need to make sure you have good systems in place that when the financial administrator or manager will come back in the morning, they can check against the diary system or the appointments or whatever it is, against what money was received, you know, to make sure that there's good controls in place. So you need to have internal controls around that. You need to have a fraud policy as well, you know, so that staff are aware, if they become aware of fraud, or whether that there's a means of them reporting it, you know, and that, you know, if they're not happy to report it to management, or, you know, they feel that may not be appropriate, they can go to the board of directors. And if they don't feel that that's, they need to go higher, then there are outside agencies that you can report as well, whether it's the independent auditor or whether, you know, it's the financial ombudsman or something like that, that there is actually, there's somewhere for the staff to go to report if they feel they need to, or they're aware of something and they want to make it known. Tax clearance, again, you know, again, you're probably all aware of the financial circulars 13/20/2014, I think, one where funding agencies have to have tax clearance. And again, you know, you'd be all aware that's got on Ross now, and it's alive. You know, you get an access code that you give people and they can check your tax clearance. And again, that's funders, but pretty standard stuff again. Financial reporting. So I suppose all your financial management and all your reports and it all, you know, eventually culminates in your end of year annual financial statements, you know. And I suppose the compliance for that really is, if it's a company, you have Companies Act 2014, you have the Financial Reporting Standard 102, which again for charities, SORP is there as well in FRS 102, and a lot of charities are reporting their financial statements now in compliance with SORP. And then you have, as I mentioned earlier, you have your circulars, you know, that if you're getting funding from state agencies, you have to report in your financial statements a fair degree of information really about the government department it's coming from, what agency it's coming through, the name of the program, and so on. And then you have also the charities regulator and the revenue commissioner as well, the charity section as well, that you have to do your annual return to them. And again, there's more information required for that return as well. So I suppose there's a lot of guidance around that kind of stuff really and your external auditor obviously helps you with the financial statements and so on as well. But, you know, there's an obligation to adhere to company law, and you sign up your service level agreements and whatever, your grant agreements with state funders. And again, there's an obligation to comply with the conditions in that as well. Audit versus audit exempt. Most funders require accounts to be audited. And again, you know, the charity regulator, if it's under 100,000, they don't insist on it being audited, but anything above that they do. The company constitution may also stipulate that the accounts need to be audited, you know, so in that case, the organization has no choice, but, you know, the members or whatever might decide that the audit is too onerous. the organisation is too small, it doesn't need to be doing an audit. It can go and amend the constitutions at an AGM or an EGM as well. And then management accounts, we talked about it earlier. Your basic income and expenditure reported against budget, detailing your variances. You might also have income, if you have multiple funding streams, you might have an income and expenditure by funding stream. And balance sheet, again, at month end or period end to show, what money is in the bank, what money is owed in, and what money is owed out. Staffing costs, we talked about that. Every organisation, once you have staff, you're obliged to operate the whole PAY system, PSI system, and deduct from put in your gross pay and all that, deduct your PAY, PSI, and issue pay slips to employees, and document all your procedures around the whole payroll process. Who's responsible for doing it, who signs off on it, and then right down to how it gets paid. And then obviously all that information, is submitted from the payroll package to the revenue commissioners every time a payroll run is done, or when pay is signed off on. Other considerations, smaller stuff, employer pensions. There's often organizations that the employer will contribute to pension, but again, just to be mindful, sometimes you need to get funder approval for that. Travel and subsistence. Some organizations have travel and subsistence. They'll follow civil service rates. If you're going to try and pay out more than civil service rates, well, then you need to get permission from the revenue. So it's unlikely you'd be going that route. And certainly you can pay less. There's no problem. But oftentimes you'll have your travel and subsistence policy within your financial management policy. But some people have a travel and subsistence policy outside of it as well. Staff attendance, again, a lot of funding is given based on the time, I suppose, or the number of staff you have and the time that staff spend on particular work or schemes or programs or whatever. So sometimes, automated time management systems might be worth looking at as well. Also, the distinction between employees, contract of service, and contracts for service, self-employed people. Again, this often comes up with funders as well. Now, it's a grey area because there's an awful lot of little things, I suppose, that can support your argument for, is it a contract of service or a contract for service? And sometimes it might be just given by the fact that you can't get an employee to do the job and you need to contract it out to a contractor to do it. But again, you just need to make sure you have proper contracts in place and that your logic and your thinking for going one way or the other is very clear. And then redundancy, I suppose, we talk about reserve policies and whatever. I suppose every year or the longer that a staff member stays, there is, I suppose, in a sense, your redundancy obligation, which may or may not happen in the future, is increasing every year. So you may need to build that into your reserve policy and make sure you have enough reserves put aside for that sort of an event down the line. And again, a lot of organizations, employees use their own cars. Again, you have to make sure that, that maybe that you are noted in their insurance policy. This, should anything happen, that employee while working or driving their own car for work purpose is covered. Tendering and public procurement. This comes up an awful lot with funders in particular, and they will, I suppose, gravitate towards, their own. The HSE in particular has a big suite of stuff really on procurement and the tendering process and all that. Now, most organizations, most of your expenditures will not, fall into these categories, but some may. So I suppose you just need to be always mindful. Do you need to be going into getting quotations into a process, before you engage suppliers for certain things, or and the same with tendering if you're looking for bigger items and whatever. And I suppose that all ties into then who has responsibility within the organisation to make the call on that expenditure. So your procurement may also tie in to what management can do without involving the board, or when the board is needed, to be involved in that.